Low PE doesn't always mean cheap. Hello, fellow investors. I had to cover this stock because it's gaining popularity among value quote unquote investors. Basically, because of two things: the shiny low PE and the high dividend yield. If I were you, I wouldn't look and buy the stock on their PE. If you look at the revenue graph from 2012 to 2021, you could say that the revenue growth is dead for the stock. Revenues may have tapped out, or you could say it's very cyclical. There'd be years when revenue is doing okay, there'd be years when revenue is not doing okay. Just from that, I wouldn't think of my dividends to be safe with the stock. And I certainly wouldn't buy the stock for the sake of dividends. It's the same with PE. There will be cycles for this market, so there'll be very little, if not no EPS growth for this stock, and that makes it look like a value trap. Like the stock price is not going anywhere but within a certain range. This stock will always have PE of like 4 and lower every quarter as it goes down. The market is valuing this stock cheap and with reason. This will have a 4 PE here, this will have 4 PE here, this will have PE of 4 here. That's why I don't think it should be valued based on their earnings, as it will be confusing to buyers who are DCAing into this stock. This is why I would rather value SWBI for their equity. I would buy them for their PB like I would for Walmart, Amazon, Costco, and other retail stocks. Those stocks don't necessarily trade on PE and price of free cash flow because the PE is not a metric for all. It just doesn't work on all stocks. You have to know what works for each stock. And the metric that would work best with SWBI is the PB because of its cyclicality. I mean, look at their equity from the lows and the highs of pandemic. It barely moved. Well, it moved, but like for only 100 million only, plus or minus. If you're basing your thesis on this stock for their equity, it seems to be a very stable metric. Here's SWBI valuation summary. Yes, it is cheap and technically a buy. They have decent margins. My fair value is $15. Go to Focus's intrinsic value is $28. But look, if I change the EPS, the fair value would dramatically change. And this will happen because of the stock cyclicality. And yes, it could get cheaper. It's only a buy in my valuation summary because the metric that works here is the PE. Remember, I pay 1 PE for 1% of the margins. I could always pick the lowest margin, but the EPS is not a constant number. And it moves significantly. And that's why I don't always value stocks like that. And that's why I think SWBI shouldn't trade by the PE. Here's SWBI's charts along with their fundamentals at the highs and lows of the quarters. Look at their numbers. They've been cheap all this time. Does that mean you've been DCAing on this stock? My fair value for SWBI would be at 1 PB. But I will suggest you add a margin of safety of around 40 to 60%. Personally, I would use 60%, meaning I'd only be buying SWBI for 0.4 times book value. Why 60%? Well, one, the revenue. It's not growing. It's cyclical. You want to pay cheap for the stock. Two, the nature of the stock. I thought it's a sin stock. They sell firearms. I use the same margin of safety for Altria and Philip Morris. I use 60% margin of safety for all sin stocks. It's controversial, heavily regulated. It just faces a lot of headwinds. And you want a margin of safety for that. And lastly, the dividends. I want the dividends out of the price when I'm paying for a stock. My fair value for this quarter for this stock, SWBI, is at $8. Some people would buy it here, but I don't think it's a good idea. I'd only be buying SWBI with 60% margin of safety, and that price is around $3. If you also take a look at their forecasts, they're still looking for a decline in revenue and profitability. You might not want to buy the stock just yet. The forecast is to the downside. That's my take on SWBI. Don't value this on their PE. Look at their equity instead and use a margin of safety. See you next video.